Welcome back. We are 1 hour away from the opening bell on Wall Street for the kickoff to the first full week of the new year. Markets have turned mixed. Dow Industrial's now negative, down 39, but the Nasdaq is up 154. We are watching oil prices this morning following the overthrow of Venezuelan dictator Nicolas Maduro. Oil prices hardly moving. Up a fraction at $57.85 on crude right now. But energy stocks are skyrocketing, particularly Chevron, which is the only American company operating in Venezuela so far. Right now, the stock is rallying. It had been up close to 8% earlier, and in the pre-market, Chevron right now is up better than 6%. The others are higher, as you can see. Valero Energy also up 8.25% right now. We are getting reaction from across the world. Beijing claiming it was, quote, deeply shocked and firmly opposed to the capture of Maduro. Hours before his capture, Maduro was actually meeting with a Chinese envoy in Caracas. All this happening as Venezuela sits at the center of a broader global shift, selling oil to China in yuan, not dollars. BRICS nations pushing away from the dollar, or trying to, as China tries to expand its own financial infrastructure. Joining me now with a look at markets in the face of all of this is the president of MacroMavens, Stephanie Pomboy. Stephanie, good to see you. Give us your sense of what this Venezuela story means for markets and the dollar.
Well, it's a tremendous story, Maria. Obviously, we have come a long way from the days of Obama on the apology tour around the globe and the U.S. kowtowing to the UN and letting rogue actors all over the world just kind of run roughshod. President Trump has really reestablished the U.S. as a force for peace in the world. And is really shoring up the Western Hemisphere through these actions. And I would argue that this action in Venezuela really dovetails with the tariff diplomacy, which is perceived as being primarily about trade, but I would argue is equally about national security and preserving peace. A lot of the peace deals he's negotiated have been the result of threatening with tariffs, et cetera. So I think this is a huge example of this shift, obviously, with the U.S. reasserting its dominance on the global stage. But also, as you mentioned in the intro, it's really important vis-a-vis China, and especially its Belt and Road Initiative, which it has been undertaking for more than a decade. And the U.S. has kind of been sleeping through this basically Cold War for resources that China has been waging, procuring strategic resources all over the globe through relationships with Southeast Asia, Africa, Eastern Europe, et cetera. And so we finally have a president who recognizes the urgency of waking up and getting into this Cold War for resources and procuring these resources. I don't think it's an accident that while everyone else was talking about the implications from Venezuela about Cuba and Nicaragua, that the president was focused on Greenland, not Nicaragua and Cuba. So I think we're finally in a position where we have leadership that recognizes the stakes and is taking actions to address them.
Yeah, it's a great point, and it certainly is a major message to our adversaries like China. Stephanie, how do you want to be positioned in 2026? You've been talking about higher interest costs on debt, combined with the income increase that you're expecting from the One Big Beautiful Bill. How are you analyzing that, and what are you expecting in terms of economic growth? And let me just say that I spoke with Louis Navellier recently, who is expecting 5% GDP in the new year at some point. Here's what he told me last week. Watch this. What is your assessment of the macro story? How do you want to be invested in 2026, Louis?
We're going to hit 5% GDP growth. We're running 3.5 to 3.8 now, but they're going to be revising it up because the trade numbers, the trade deficit's the lowest in 5 years. The export's the second highest ever recorded with low oil prices. So that's going to big upward revisions. Obviously, a lot of the growth was onshoring, but even and the data centers. But if you look at the data centers, their order backlogs are up 20% quarter-over-quarter. So we're going to enter the new year with we're going to hit 5% GDP growth.
5% GDP, Stephanie. Do you agree with that? And how are you invested in 26?
Well, I'm not quite that optimistic on growth. If he believes that, though, and if that's what happens, what's the case for the Fed to cut interest rates? So I think, I keep coming back to interest rates as the key determinant of the path of growth, just because we're an enormously levered economy, not just in the public sector, but the private sector also. We've talked about the enormous amount of corporate debt that rolls this year and the onerous debt burden that is confronting consumers. They're not really getting much relief on mortgage rates so far. The hope is that they will. So my concern, as we've talked about, is this push-pull of the stubbornly high interest expense that will be offset to some degree by the stimulus from the One Big Beautiful Bill. The question is whether it will be sufficient or not, and whether we can actually coax these long rates downward, which has not happened as yet. We've seen 6 Fed rate cuts without much impact on the long end of the yield curve. So this is what I'll be watching closely. And as yet, there's no indication that we're going to get much relief in terms of long-term interest rates. So again, I'm overweight hard assets versus paper on the expectation that the Fed will have to expand its balance sheet to achieve the results that the Fed funds rate lever isn't achieving. And that continues the trade we saw over the last year, where precious metals have performed paper assets. So that's where I am for 2026.
Well, listen, you're in the money today. Gold and silver this morning are soaring, as are other commodities. Stephanie, always a pleasure. Thanks so much, Stephanie Pomboy.
Thanks, Mary.